This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
Price leads narrative and price shapes attitude. Two truisms proved correct in almost every market cycle. Overconfidence and the sense of infallibility have yielded to fear and loathing in less than 2 weeks, and now maybe back the other way to a degree. The headline writers are spinning new takes as fast as they can type. So up next, have fundamentals changed as much as emotions? Let's talk about keeping a clear head. Welcome on board another edition of our Wise Investor Group podcast. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. Believe it or not, I took 4 years of Latin in school, which you could argue was a complete waste of time, but I did preserve some key points from that exercise, that coursework, and one, of course, was the readings of Horace, the famous philosopher who espoused the idea of aurea mediocritas, preserving the golden mean. And that's something I've carried with me in my investing career, right? Simply put, don't get too high, don't get too low, right? Emotions are your worst enemy. I've talked about this ad nauseum over the course of the last 15, 20 years. But it's really, we're reminded of it again just in the past 3 weeks. We went from euphoria about the AI trade, considered the infallibility of the AI trade, to complete despair and desperation that everything was going wrong there, that we were overbuilding, that this was a dot-com bubble, and then back the other way towards the end of the week on the heels of the NVDA earnings, right? Preserving the golden mean is probably the best course of action because the trade du jour can come off the menu very quickly, and preserving proper portfolio balance, because when the bloom was coming off the rose in AI, what was happening? Money was rotating back into other areas like healthcare, like energy. I'm going to talk about that today. That's kind of the theme of this show. Like I said, up until the NVIDIA earnings, which were released Wednesday evening, it was kind of a bloodbath in the AI space. Right? And really, I would not just the AI space, really anything speculative, including, Bitcoin, for example, a lot of these meme stocks, anything that really requires emotion, right? Momentum, liquidity, all those areas were getting trashed pretty much in unison over the past of the few weeks, which, again, kind of, as I hinted at in the opening, reminds us of a few key lessons. One is the famous quote, of course, from Benjamin Graham, the patron saint of value investing, Warren Buffett's mentor, who said, in the short term, the market is a voting machine. The long term, it's a weighing machine. In the short term, markets are determined by emotion, momentum. Long term, fundamentals kick in. Earnings, sales, valuations, but anything can happen on a day-to-day, week-to-week, even month-to-month basis. The second is that price shapes attitude. So, very rarely do all the headline writers, all the media start talking about something before it happens, right? You see the market turn, either get more bullish or more bearish, and then out come the headlines to justify, to explain in retrospect what is happening, right? Price shapes attitude, and price relatedly leads narrative. Very important concepts. But let's dig in. Let's start with that as the premise and dig in. Strategists noted that before NVIDIA's earnings, which kind of sent things back the other way, back to, I don't want to say euphoria, back to a more positive bent on AI and the AI landscape. Before that, November's weakness was concentrated in decile 1 and decile 10, meaning the stocks, if you break the performance of the S&P into deciles through October 31st, the 10% worst performers and the 10% best performers, those were the ones that were imploding the first few weeks of November. So what does that tell you? The names that have really been struggling for the most part have continued to struggle, okay? That's not a huge surprise, particularly as it gets exacerbated by year-end tax selling, tax loss harvesting. But it was the stocks with the most momentum that came under pressure in November. So, again, speaks to the emotional aspect of investing because, of course, some of those companies have great fundamentals. Nobody cares. Emotionally, they all sort of traded south at the same time, all right? And it was interesting, they do a poll pretty routinely, I think it's monthly, of where investors think the next 5% move in the S&P will be. Will it be up or down? And for the first time in like 6 months, the answer was down. The next 5% would be down. This is as of a week ago. So again, price shapes attitude. The fact that the market was already declining, people think it's likely to decline more. Just keep these things in mind. There's no real investment takeaway or conclusion from what I just said. It's just very important to understand how the market works, okay? And how to, if you can harness those things, harness those emotions yourself, you're probably going to be better off. And part of this, quite frankly, people are stumbling all over themselves to come up with, reasons, culpability for the sudden downturn in the S&P. A lot of it is sometimes just downturns happen. I mean, if you go back to the lows in April, we've essentially gone straight up. We haven't had anything more than a 3% pullback since April. So the fact that I think we hit 5% as of Wednesday's trading on the S&P and the Dow, I think we crossed that 5% threshold. That's typical. That's not unusual. We were due for a bit of a pullback, regardless of what the reason may have been. Maybe it was the fallout from the shutdown. Maybe it's jobs numbers. Maybe it's AI bubble fears. Doesn't matter. We were due anyway. And sometimes the headlines are, like I said, more of a justification than the actual reason. And even if you knew the reason, would it really help you after the fact? Probably not. But it's been across the board. I mean, I noticed, Bitcoin, and again, we don't do much in the cryptocurrency space here, but Bitcoin plunged, I think, almost 30% from where it had been earlier in the year. And Bitcoin ETFs saw about 1.3 billion in outflows in less than a week. So again, Bitcoin, almost by definition, there aren't really any fundamentals there, right? Or at least fundamentals in a traditional sense. Yes, you could argue there's some supply-demand dynamics, but we're not talking about sales and earnings and the other things that we use to evaluate stocks, bonds, even commodity prices in some ways. It's all based on emotion and momentum and liquidity. So Bitcoin is another example of that. Meanwhile, one thing that I've spoken about a lot over the course of the last 7 or 8 months is, where has the money been going? Where's the money been going? And Strategas had another good piece on this. They looked at cumulative sector exchange-traded fund, ETF flows, since the September rate cut. So, 13 months ago, give or take, 13 and a half months ago. Well, tech far and away had the most inflows. Financial second, industrials third. Meanwhile, energy and healthcare, negative net outflows over the last 13, 14 months. So what does that mean? It means, there are other ways to look at momentum and positioning, but, investor flows, asset flows is as good as any. It meant that there was a very high bar for technology and a very low bar for healthcare and maybe energy as well. That means you need a ton of good news to keep the momentum in tech going with a very small margin for error. Meanwhile, healthcare and energy just needed, you needed the absence of a disaster, right? Even a small amount of good news or even less bad news, news that's not as bad as feared would be enough to potentially trigger a rally in healthcare. Sure enough, healthcare has been the best performing sector here in November. Goes back to what I was saying at the top. Don't get too high on something or too low on something. Keeping that balance, keeping that diversification generally works. Doesn't always work, but the vast majority of the time it works over a long period of time. What you don't know is the timing. You don't know when tech's going to suddenly start underperforming and healthcare is going to start outperforming. You don't get that information, unfortunately. So you just have to be positioned for it ahead of time. So let's just take a further look at the backdrop. We all know, speaking of the bar being high for tech, we all know about the concentration of technology in the S&P. Talked about this a lot. Specifically, the Magnificent Seven, there's 7 names at the top. Over 40% of the S&P now, I believe, according to FactSet, is concentrated in the 10 largest companies. Get this. This is also from FactSet. The Mag 7, and this is before the NVIDIA earnings, by the way. Maybe it's more today. But the Magnificent 7 market cap in aggregate is equal to the bottom 449 companies in the S&P 500. Think about that for a second. I mean, that is an unbelievable statistic. Also, according to them, Apple and NVIDIA are now worth nearly as much as healthcare and consumer staples sectors combined. So, I mean, think of all that. Pfizer, Merck, Kellogg, Keurig, Coke, Pepsi. Add them all up. Clorox, add them all up. They are worth only the same as Apple and NVIDIA. The market cap of all Mag 7 companies combined is now the same size as the energy, materials, staples, healthcare, financial, utilities, and real estate sectors combined, folks. All right? So that was the backdrop. So you can see how the bar is high, the margin for error low. But I will say, and this is borne out by the NVIDIA earnings that were impressive to say the least. A lot of this concentration, and we've talked about this before, so this is not new information to you, but I think it bears repeating. It's backed up by a similar dominance in fundamentals. The fundamentals have been matching the stock price gains. So, for example, NVIDIA, we all know, is the largest company in the U.S. stock market, but the fundamental growth in earnings and sales has actually exceeded the price growth since ChatGPT came out in the fall of 2022. Okay, so actually the fundamentals have been better than the stock price performance. And you see it with respect to, to profit margins, right? And this is a little bit of an artificial exercise, but the folks up at Ritzold Asset Management looked at the S&P adjusted for margins. In other words, adjusted for profitability. And in their work, they found that the Mag 7 stocks actually were not anywhere near as expensive as they were in sort of an absolute basis, if that makes sense. And a lot of it has to do with margins. I mean, if you look at the margins of just technology, so not the Mag 7, but technology sector in the S&P, pushing 20%, according to Ritzold. The rest of the S&P, if you back out, is closer to about 6%. So I don't say all this so as to, make the argument that, tech is cheap or anything like that. I'm not making that argument, but I am making the argument when people talk about a bubble implies sort of, a detachment in price from fundamentals. We really haven't seen that. Okay, yes, we've seen a bubble in terms of sort of interest, the perception of infallibility, the idea that you can't make any money if you don't own AI. So there's some bubblicious, for lack of a better word, sentiment around the AI companies, but the profitability has matched it. The question is, and I'll talk about more of this in a minute, is what we don't know is what does the ROI look like, the return on investment? I think that's the open question. We know that the earnings of the Mag 7 and other AI-related companies have been good and will probably stay good. The question is, all that spending, what does it lead to in terms of return on investment? That's going to be the central question for 2026. But certainly, again, going back to the bubble idea, I mean, you remember in the late 90s, right? Remember companies like Global Crossing? Remember those? Of course, AT&T. I mean, they spent, over $500 billion in aggregate laying fiber optic, cable in anticipation of rapid internet adoption. And a lot of those projections were over-optimistic. So then you had the industry with a multi-year hangover. How to deal with, a glut of capacity, collapsing prices. That's what people are worried about. But I will say, going back to the Magnificent 7 and the big names, I'm not making a pitch for you to add more Google or Microsoft or NVIDIA. That's not what I'm saying. But if there is a bubble, I actually feel personally, and maybe somewhat less in some of those names because the fundamentals are there, the bubble may be more in some of the peripheral names. A lot of the companies with zero revenue that are more concept stocks. And that's what you saw the past 2 or 3 weeks. A lot of the most speculative ends of AI saw the most pressure by far. I mean, there were a lot of like quantum computing stocks, for example, down 40, 50, 60% in literally a week and a half. I'm not making an argument as to whether you should own or not own these names, but just know what you own. Know that fundamentals ultimately will matter over the long haul, but over shorter periods of time, momentum is going to rule the roost. And if you're not prepared for that in terms of your sentiment, there's a good chance that maybe you make emotional decisions yourself, which could be to your detriment. The other thing I will just say is there's a lot of talk about the sustainability of AI spending, particularly from the big guys. Well, if you look at it, Goldman Sachs came out with a piece on this that I thought looked very interesting. You're starting to see the big guys, the Oracles of the world, the Facebooks of the world, Metas of the world, start to leverage their balance sheet a little bit. According to Goldman Sachs, the hyperscalers, which are the biggest names, they have collective net debt to EBITDA leverage of just 0.2 times, so barely any leverage at all. So in their words, these companies in aggregate could add over $700 billion in net debt to their balance sheets without lifting their net leverage above 1 times, which is still a very conservative leverage ratio. So there's a lot of room here, in Goldman Sachs' opinion, to continue the spending. Again, the question is not whether then they can spend. The question is what will be the return on that investment, down the road. So that's what we'll be watching for. By the way, just a little bit of a sidebar here. I was reading the most recent newsletter from Warren Buffett, which I believe is his last newsletter. I'll talk more about Berkshire on another show. But he wrote a couple interesting quotes that I thought were very good. One is he said, "I've made many mistakes. Our satisfactory results have been the product of about a dozen truly good decisions. That would be about 1 every 5 years," end quote. So here's arguably the most successful investor of all time. We can talk about the performance of Berkshire over the last 60 years, well above the S&P 500. He's saying most of that's attributable to about a dozen good decisions. So when people talk about concentration in the S&P, or if you just look at your portfolio, I mean, if you take a look at your portfolio and let's say you own individual stocks, for example, and let's say you have 20, 30, 40 holdings, you might say, well, geez, most of my money has been made by 5, 6, 7, 8 of those. Well, what Buffett's saying is that's not unusual. That's kind of the fleas that come with the dog, as the late Rick Malone used to say, that it's being patient with some of your most successful investors and being willing to ride them out in good times and bad times, even if they go through corrections, certainly like many of the tech names have done. That's how you have a successful outcome over the long haul. You've got, having conviction in the long-term story. Doesn't mean you buy and forget, but you don't overly succumb, if you will, to emotional knee-jerk responses that other investors are succumbing to. That's what Buffett's saying, and we see that too here at the Wise Investor Group level. I mean, a lot of our performance, not going to get into specifics, but a lot of our performance over the past 10, 15, 20 years has been driven by, a relatively small stable of names. Okay, you just don't necessarily know, of course, what all those names are going to be ahead of time. That's why you can't just own 5 stocks, but I think you get the point. Let me flash forward a little bit. I talked at the top about how, over the short term, the market's a voting machine. The longer term, it's a weighing machine. I'd argue the biggest reason the market has done well over the last 6 months, I mean, people will talk about Trump, they'll talk about the Fed, they'll talk about tariffs, but the real reason, in my opinion, is that corporate fundamentals have been better than what people thought they were going to be. And here we are 95+% through third quarter earnings reporting season. This is according to FactSet. Over 80% of S&P companies have beaten earnings expectations. That's the highest beat rate in about 4.5 years. Okay? What's more, coming into this quarter, consensus forecasts were calling for, I think, about 7% earnings growth year over year for the S&P. We've come in over 13. So we're almost double what consensus estimates were calling for less than 45 to 60 days ago. That is pretty darn incredible. And that's, quite frankly, that has been the case for some time. We're also beating on the top line with revenues. Revenue growth, according to FactSet, up almost 8% year over year. So you can have corrections at any time for any reason. We saw that the past few weeks. But it's very tough for the market to get into too much trouble when you have revenues growing at twice the rate of GDP. Okay, it's tough to have a sustainably bad market, Now you could argue, well, that's rear view. What about the future? Well, looking forward to 2026, the street has already revised earnings and revenues upwards from there. We're at currently 6% revenue growth, 14% earnings growth for 2026. Now take that with a gigantic grain of salt, a whole spoonful of salt, because of course things can change. Anything can happen right in the economy, but that's where we are today. And I would argue that's the main reason why the market has done well. A lot of that, and I would make just 2 points about that. One is it's pretty broad-based. For the first time, I think since 2018, according to FactSet, every sector is expecting to have better earnings next year than this year. That doesn't happen very often. Okay? Secondly, corporate profit margins are running around 13.5%. That's the second highest level ever recorded. So despite tariffs, despite energy costs, all these things, labor costs are slightly up, right? Despite all these things, corporate profitability is about as good as it has ever been. And you could make the argument that could even improve further if we do get that return on investment from AI, if more companies adopt AI, get more efficient. This is also, of course, the time when we start to get price targets for the S&P from the big Wall Street houses. I've said for many years, disregard them, because I think they're a waste of time to regard them. But that doesn't mean they're completely useless. And I would just keep a few things in mind when you start to see Goldman Sachs and JP Morgan, Raymond James for that matter, Merrill Lynch, Morgan Stanley, come out with their S&P projections for the next year. I would say, one, focus on the direction of the target, not the target itself. Most of the competent strategists and analysts, they'll tell you it's less about, hitting it with precision and more about the direction. Simply put, do they expect the market to be higher or lower? What's also noticeable is price targets are not accurate traditionally. Earnings targets tend to be more accurate. So for example, I saw this from FactSet. Coming into this year, analysts forecast full-year S&P 500 earnings of $274 a share. As of a week ago, we were on track to hit about $270. That's pretty darn close, folks. That's within 1%? That's about as accurate as you're going to get. Over the last 10 years, earnings estimates have been pretty close. So going back to what I said 2 minutes ago, a lot can happen in the economy. Don't take it to the bank. But, if analysts are projecting double-digit earnings growth for next year, that's a pretty good sign. Where things tend to go wrong are valuations, right? There are two components to a stock price, the earnings and what you pay for those earnings. A lot of analysts thought that valuations would come down this year. That has not happened. Valuations have actually expanded. So keep that in mind as well. That will be a big driving factor for 2026. A lot of that will be determined by interest rates. If inflation, let's say inflation picks up, let's say interest rates pick up, let's say the Fed is more hawkish, that might be a more challenging environment for valuations to stay as high as they are. Okay. The last thing I'll say is anybody who comes out with kind of average returns, I discount automatically. We all know that the market has been somewhere in that 8 to 10 range, 8 to 10% growth range for the past 100 years, right? But the market almost never does 8 to 10%. It's very rare. In fact, it's only happened, according to the Carson Group, 4 times since 1950 that the markets have actually done the historical average. Probably going to be a lot higher or a lot lower. So I won't belabor the point. I just wouldn't spend a lot of time listening to the numbers, but I would pay attention to the earnings forecasts and the directionality, which I know is not a word, but the directionality of where these analysts are going. Just to talk a little bit about the economy, I don't want to spend a lot of time on the economy, but I do think there are a few things worth noting in the big picture. The odds of a Fed rate cut, if you believe the futures, have gone down precipitously. About a month ago, Wall Street thought there was a 70% chance of them cutting in December. That's down to 30-some% as of the end of this week. And that's largely because the Fed is still, one, they're kind of flying blind, right? Because a lot of the traditional data they rely on has not been posted because of the government shutdown. That's one thing. But two, they're in this kind of middle ground where, yes, there is evidence that the economy is weakening, but they're also worried about a pickup in inflation. So we saw this week, the minutes from the most recent Fed meeting, there were more Fed governors not wanting to cut than cutting, which of course is not pleasing to the Trump administration, but that's kind of where we are. It's pretty obvious. Yes, we got the September jobs report, was a little better than expected. So we're not seeing, at least as of the end of September, a collapse in the job market. But there is pretty clear evidence that the job market is stalling. Job creation is stalling. Job openings are falling. Hiring activity is slowing. Workers are staying put. And unemployment may be starting to pick up a little bit. At least there's some evidence of that in October. So that's kind of inarguable at this point, that we are seeing some cooling and very much an economic soft patch here in the fourth quarter. There are a lot of reasons for that. Slowdown in immigration, reduction in government hiring, adoption of AI, right? Tariff-related costs and sort of related uncertainty. But on the flip side of that, there's more evidence coming out that tariffs are actually deflationary. In fact, there was a paper from the San Francisco Fed. It was a study that was just published in the Wall Street Journal about a week ago saying just that tariffs are deflationary, resulting in higher unemployment and eventually lower inflation. So why do I bring this up? Because there was all this talk of, the tariffs being inflationary. And that's not to say that tariffs are good or bad, but it may be the opposite. It may be that tariffs are a drag on economic growth, a drag on employment. And so I think as we get into 2026, that'll be something that the Fed is going to pay a lot of attention to. Because remember, they have two mandates, inflation and employment. The employment side of it may get a little bit trickier. The other flip side, there are two flip sides, is that there's a pretty strong, I'm not sure I'd use the word avalanche, but there is a pretty strong tailwind of economic stimulus coming in the first quarter. Remember, Congress, either intentionally or not, decided with the tax bill to make it back-end loaded. They did not do anything really upfront to stimulate the economy. But with the tax cuts, both at the individual, not necessarily tax cuts, but more deductions, SALT and what have you, and deductions for the way that corporations can expense certain things, depreciate certain things. It's back-end loaded in the sense that corporations and individuals won't really get that money until they get refunds back, so March, April, May, not so much now, right? So there is a lot coming down the pike. I mean, Strategas has talked a lot about this. They think the incremental stimulus is as much as $250 billion between businesses and individuals. Plus, of course, there has been at least a couple rate cuts, right, and maybe more in 2026. And the Fed has stopped their balance sheet contraction. So I bring all this up because there is a big sort of tug of war here that we will get much more resolution on over the next 6 months between a short-term soft patch, yet the probability of stimulus in the first quarter. And of course, the idea, does that stimulus continue to feed inflation fears, or do we get a more pronounced economic slowdown in terms of hiring and employment that actually brings inflation lower? We just don't know the answer to that, but that's kind of what's at stake. And going back to my premise of the show at the very beginning, we're probably going to have vacillations in how the market sees both sides of this potential narrative, right? One week, the data might suggest we're tipping towards recession. The next week, market might be suggesting, hey, we're about to ramp up activity again. We'll try to keep a level emotional playing field over here at the Wise Investor Group, and of course, we'll let you know if our outlook changes at all. All right, hold that thought. Want to take a quick break when I get back. I do want to just give you the latest on a few individual names that have been in the news recently. Stay tuned. Back in a sec. Private wealth management goes way beyond picking stocks. Do you have a well-thought-out, cohesive strategy to grow, preserve, and pass along your wealth? Tune in every week as we discuss how to think about your big plans and how to become a better-informed, wise investor. Listen to us at The Wise Investor Group at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app. Raymond James Financial Services Incorporated, member FINRA, SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the Wise Investor Show. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. As promised, I do want to bring you the latest from a few of the top holdings in our portfolio. As always, I will say this, that the names that I'm about to mention, I own personally, and we own in many of our client portfolios. You could consider that a conflict of interest. If you are managing your own portfolio, please remember you have to do your own research. I don't know if these are appropriate for you. If you're a client, I think you can feel confident that we've done our due diligence. We've determined that these are suitable for your particular financial situation. So, of course, the big story this week was NVIDIA. I've spoken at length on this podcast about how the worm kind of turned with AI sentiment. We went from euphoria to despair in less than 2 weeks. Talk about bubble really heated up, and we saw a pretty significant sell-off. 40, 50, 60% in a lot of the AI-related names. We also saw a sell-off in some of the biggest names, Microsoft, Amazon, NVIDIA, ASML, and others, but certainly not to the degree that the more peripheral and maybe less well-capitalized names did. But NVIDIA is the poster child. They are the bell cow of the AI space, and they reported earnings after the close on Wednesday. Market's reaction on Thursday was positive. Just taking a look at a couple of the highlights from FactSet, some of the things that kind of stood out to me, an Evercore analyst had a good take on this. One is, the last 5 quarters, you had seen a deceleration in top-line revenue growth. Well, that was not the case here. They appear to have reversed that, and revenues are actually going to accelerate from about 56% growth in this quarter of 25, according to NVIDIA, up to 79% July of next year. That's the forecast. So not only did you see current acceleration, but the prediction for more acceleration going forward. And the commentary from the CEO at NVIDIA was about as bullish as you'll find. What you also saw was a 32% increase in inventory and a 63% rise in supply commitments. So remember, there's been a lot of talk about NVIDIA having the capacity to meet the need. They appear to have addressed that. The other thing I'll say, and the Evercore analyst noted this, is they're now trading about 25 times forward earnings. I'm not going to sit here. I don't think anyone would say that NVIDIA is cheap, but 25 times earnings does not sound crazy for a company with their market position, their revenue growth, their earnings growth, particularly when some of the more speculative names are well over 100 times earnings. So again, value stock, nobody's making that argument, but maybe not an unreasonable valuation. The big thing, the negative side of it is, and I've mentioned this earlier in the podcast, we still don't know what the ROIs are, right? What the return on investment is going to be from all this spending. That'll be, again, a central question for 2026. At some point, Do companies realize, yes, this spending is worthwhile, we need to spend more? Or do companies say, you know what, I've been spending billions and we just haven't seen what we thought we were going to see? That's what, of course, what we saw back in 2000, 2001. We don't know the answer to that question. But for now, that NVIDIA print really excited the market. And so anything that was sort of tech/AI oriented had a big up day on Thursday. I wanted to mention a new addition to the portfolio, and again, I own this name personally as well, that we just started buying for folks within the past 3-4 weeks. GE Vernova, symbol GEV. You may be familiar with the name, of course, a spinoff from the parent company a number of years ago. I don't know exactly how you would classify them. I mean, essentially, they provide, if you read their official company description, they provide products and services that generate, transfer, orchestrate, convert, and store electricity. So they're the global leader in a number of kind of power, specifically electricity-related end markets. And they're basically a pure play in what they call electrification and power generating. And they do that through 3 divisions. They have a power segment, which is their gas, steam, nuclear, hydro turbines. Okay, they are the largest gas turbine company in the world. It's where a lot of their recurring revenue comes from. About 70% of that is long-term contracts. And that segment drives the majority of their free cash flow and margin expansion. Then they have a wind segment. They manufacture onshore and offshore wind turbines and blades, for that matter. That's probably been the sector that has been under-earning the most. The margin profile has been poor recently. That's also tends to be the most politically sensitive area, right? As the Trump administration has not been particularly positive towards wind energy generation. But according to the company, in 2026, that should be the inflection point where things start to get better for them. And then the one that's probably gotten the most attention from Wall Street has been their electrification segment. Grid equipment, for example. That has been far and away fastest growing segment of their business. And a lot of that really started to come about before AI, right? Just because of our aging electrical grid in this country. I mean, there's a lot of demand for upgrading that in virtually every populated area in the United States. But it's also the central area of focus when investors start to think about the incredible energy needs that data centers and AI in general are going to need. Okay, so GE Vernova is very much at the forefront of that. I mean, the outlook for power demand and investment is stronger than it's been certainly at any point in my career. You know, I've been doing this since 1992. Now, and they're in a great position to capture a lot of that. You're certainly seeing market share expansion. There are capacity constraints all over the place. I think that the trick for them, of course, is going to be the bottom line margin profile. You know, what they do is capital intensive. They think that they're on the cusp, according to their own notes and own analysis. GE Vernova management thinks they're on the cusp of a major inflection upwards in margin. They think that their margin progression could be enough to see 30 to 40% earnings growth over the next few years off of roughly about 10% sales growth. So they think the margins are going to provide them a lot of operating leverage going forward. Again, I think the risk is, one would be what I said earlier, just the risk of overbuilding, oversupply in AI, which leads to, you know, these projections being hogwash, essentially. The other risk is the valuation. You know, GE Vernova, we knew it was not a cheap stock when we bought it. But if you look at them versus 2027 numbers, not unreasonable. You know, they're about 50 times this year's earnings, but then they start to trade into the 20 to 30 times 2027 earnings, and they've been very conservative in their projections. So there's the potential for the stock to be a lot more reasonably priced than maybe people think. We'll get a better read on that. After Thanksgiving, they have an investor day in early December when they sort of will lay out their targets. But that's the hope. The hope is that they are underestimating their future growth potential. But it is a volatile stock, and there are risks to the story. So this would be sort of for part of the, in my opinion, sort of the growthier part of your overall portfolio if you're going to participate. The one other I just wanted to mention briefly is the news flow from Eli Lilly, symbol LLY, has become increasingly positive. You may have seen in the news that the Trump administration came to an agreement with Lilly and some of the other weight loss drug manufacturers to really reduce the cost pretty significantly for, Medicare and other government-related programs. And Eli Lilly management has been very public in saying, and there was a really good JP Morgan piece on this last week, that this will be a major tailwind for them. So in other words, even though they're having to produce for government transmission to patients at a lower price point, their margin profile is high enough, and they think that the revenue creation through being exposed to many more patients will all be a lot more positive than had the price not being reduced. Let's put it that way. Okay, so in other words, you're sacrificing margin, but the revenue expansion, the sales expansion should significantly offset any potential drag from the lower prices. That was a kind of a convoluted way of explaining it, but I think you get what I'm saying. And the JP Morgan analyst thinks it's the top name to own in the entire pharmaceutical space. I would also tell you that Eli Lilly is not a one-trick pony. There's a lot of talk, of course, about their weight loss drugs that originally started as diabetes drugs. But there are new delivery transmissions such as, oral, one pill a day. So they're constantly making it easier for people to take these drugs. But they also have some pretty significant opportunities in other diagnostic spaces. For example, Alzheimer's. They have arguably the most effective Alzheimer's drug in the market at this point, and they think that could have significant upside. So I would say the risk to Eli Lilly is not so much the valuation. I think it would be just the competitive landscape, right? There are a lot of companies kind of trying to play in that same diagnostic space. That's probably the biggest impact, and there is some political sensitivity there from the Trump administration, but that appears to be now, like I said, maybe more of a tailwind than a headwind. So if they can continue to execute from a research and development perspective, Eli Lilly looks like it could be a core holding in the healthcare space. So take a look there. So again, those are three names that have been very much in the news recently. We are towards the tail end of earnings reporting season, so there may not be as many earnings to get to. We will hear from Broadcom, another key player in the chip space, the AI-related chip space. I think that's towards the middle of December, so keep that one in mind as well. Hope that was helpful. As always, I wish you wise investing, and maybe most importantly, I hope you and your family have a very happy, safe, and relaxing Thanksgiving.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the WISE Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.